Sarabjit Kour Nangra, VP Research at Angel Broking, is now joining us. Sarabjit, good morning. You just heard the management. Would you still worry about the guidance, or it's still a guidance which will lead to a lot of EPS cuts?
See, in terms of EPS cuts, I doubt it will, because the thing is that the guidance given is constant currency, and the projections that come out is rupee, and the targets are based on rupee revenue and rupee EPS. There I don't see much happening, because rupee is also, if dollar strengthens, rupee tend to get depreciated. So it's a trade which is a currency trade. So if you see weakness somewhere, then it gets, that's my experience in the export oriented industries, that they tend to get compensated because of the currency. I'm not saying that you should be buying that. What I'm saying is, in terms of EPS cut, I don't see much happening actually. Coming to the other point, yeah, the guidance is pretty sharply cut. A part was expected because of their key client moving out, but it was more than expected, or I think warranted also in some sense. So clearly indicates that the macro trend that has happened after Brexit, which had made even managements like TCS, which are more positive and more optimistic and more consistent in terms of their performance, come out and say that they see a Brexit related macro environment which is not something which will change the fundamentals, but in the near term could be uncertainty which will play out and will be reflected in terms of execution. So I guess that's what playing out in IT right now, and so I'm not so much worried. As far as Infosys particularly is concerned, yeah, under this management, we have seen, what bothers me is that, every quarter they come up with a guidance, which is in a way, it's not disturbing, because the macro environment is dynamic, but then somewhere I think I would appreciate if companies move out of that zone and would be able to forecast and would execute given the dynamic environment that we are, and stick to their long-term goals. We have seen that in case of leadership under Narayan Murthy. We had seen pricing pressure then also, but the company stuck out at gun and stick to contracts wherein the pricing pressures were not there. So in the dynamic scenario also, when pricing pressures are huge, there are opportunities where you can withstand that pressure and maintain your profitability. So that time the management was clear they will not sacrilege profitability. So I hope that's the same scenario in current state of affairs in IT sector, that most of these managements realize that this is a dynamic situation, and the only way to cruise through is to make sure that the profitability is not sacrilege. So I think if that companies manage it pretty well, then growth somewhere will not be that disturbing, because after all, it's given that if RBS would have been included, then probably it's a situation wherein growth numbers would have been tinkered here and then. So, and as it is in a industry where profitability is a major component of your valuation more than growth, I guess it's profitability which should be guarded more than growth. So if that is guarded, I think in the near term these companies will cruise through with less bleeding, I guess, and that's what I'm hoping that these companies focus on. Because in the dynamic situation they are finding it difficult to manage growth in a very in a secular way, or in a way which gives comfort to the shareholders. So I guess that's the call. So I think this scenario will make sure that you will figure out companies which can handle dynamic, and for Infosys especially, because this is Mr. Sikka's a role which he has been saying that the industry needs a rethink. So I think rethink is that the situation. In a way, it's a rethink, because there are various plays happening. You have a scenario where they see a lot of pricing pressure, a lot of macro trends happening. Then you need, but I think these are levers which are true for any industry, any given situation. Managements which are good in cost optimization, good in riding over the dynamic pricing situation, which keeps on happening in every industry after particular years. So it's nothing new, but yeah, you need that kind of temperament from the top management, and execution skills to tide over. So I think for Mr. Sikka, it's testing times, and I guess people are now concerned whether they can live up to the vision. So I think those questions will arise, and I think if they are adequately answered, then probably I think the stock or the company should do fairly well, apart from the near-term gyrations which are there because of the Brexit and other kind of macro trends that are triggers that are available actually.
As far as a derating is concerned, will this become a derating event, or people will just wait for a pickup? Because they just can't go declining. They just can't be flat quarter after quarter. And if that is the case, there's sufficient opportunity to sell even later.
Being a fundamental analyst, for me to point out which is the tipping point in terms of valuation, because currently, as I said, these businesses today are also is the most profitable business in the apart from FMCG and diagnostic. Since I track pharma, I can put a diagnostic business. Apart from these two business which come to my mind, third one is IT. IT is the highest ROE generator in terms of services. So business which generate ROE 50% and it's growing at, say, even, I'm not saying it, they have the potential to grow at obviously at 14-15%, but currently, given the scenario for the current year, probably they will end up with 9 or 10% or max to max 11% kind of a growth. I think that's what I'm saying. When you value a company where the ROE component is heavier than the growth, then the companies like Narayan Murthy did in his heydays, or when Infosys was going through such challenges then also, they focused on ROE because it's a bigger pie in the overall valuation and the profitability, or even generating wealth for the company and the shareholders. So when dynamic situation comes in, I hope that they don't sacrilege, as many analysts have been pointing out. It's better that they sacrilege profitability, near-term profitability for growth. I think such situation keep on happening. You can still grow by being profitable also, because
right. As far as Infosys or TCS is concerned, if you just look at the reaction, so Infosys is now settling down. It's down about 1.6. Let's look at TCS. It actually never fell. So TCS did the way it is. It's absolutely on the flatter side. Sarabjit is, I think, back with us. Sarabjit, okay, she's back with us. Sarabjit, TCS, how would you react to those numbers? That was a weak set of numbers and would lead to downgrades.
Yeah, we are in the process of it because the result was announced yesterday. I'm still in the process of recalculating the numbers, but that stock will be getting some cuts happening there. So both of them will see some cuts happening, but I think it will not be drastic cuts so far. I don't think it will be such a major cut happening, but yeah, there will be some cuts happening because of FY17 numbers getting revised downwards in both the cases.
As far as something like a TCS is concerned, you heard the management commentary. Was the management commentary positive, you would say, or Q3, Q4, you will still wait for the numbers to be better than the previous ones?
As an industry, it's known practically that first half is better than the second half, and only few companies like TCS have been able to at least deliver decent volume growth, though not comparable to the first half, but decent ones in the second half also. So I guess second half we are not expecting much, and that's evident from the guidances that coming through. So I'm not expecting a very strong second Q. What I'm looking forward is an inflection point, because I think everybody in the street understands that IT sector from a valuations perspective and an investor perspective is in a value zone. So that's not denying. We all are looking at a point when it starts moving. That's the reason that after sharp falls that has happened, the stocks are not reacting so much badly to the news that's coming in. Probably, a little bit of, reaction could be the extent of 5 to 6%. I think so that could happen. Given if markets become weaker, they could see a much sharper reaction. But apart from market risk, I have to evaluate just the business. I guess they are factoring in that they are waiting. I think the stocks are priced at that value that they are waiting that this momentum starts and moves forward the way it should be, and which even companies underlying believe that it's possible to achieve those kind of numbers. So I guess even they are not clear, so that's the reason that it's becoming the situation is becoming a more nervous kind of a situation. But I guess long-term investors can look at the sector, and we are positive that it's in the value zone. And as I say, it's a typical value zone wherein you don't know how to play the sector, where profitability is high and near-term growth is not coming to the mark. But I guess long-term investors need not worry so much about it, because I guess the buffer in terms of ROE, as I stated earlier, is pretty strong for the stocks to fall sharply unless there is a untoward event happen, which could be either industry dynamics changing dramatically, which I don't see it's changing that dramatically, or market risk, which I can't forecast right now. So apart from these two risks, I don't think there is any other risk left in the sector. Company-specific risks are already discounted, more or less, I guess. So.
As far as these companies are concerned, they'll continue to be cash-generating machines, so they could be a dividend play if, say, there is a big fall or big derating into any of these names?
Yeah, that's what I said. They have a lot of cushion because they have been generating high ROE. So cashes are significant. They can give out dividends to reward shareholders. Acquisition is one, but given their strictness towards maintaining the ROE and other things, I think acquisitions, Indian companies haven't been doing so greatly, and which in a way I appreciate, because it's very difficult to desist something to make sure that your company grows. So I think that way the IT companies have been more disciplined than any other sector. If I compare, like in pharma and all, you see a lot of acquisitions keep on happening. So that way it's positive. So other alternative is to reward shareholders. So from that perspective also there will be a buffer. That's what I said. It's a truly in a value zone where there is a lot of downside buffers now available. So company specific risk is adjusted. Possibly industry risk, I don't see much panning out. I think industry sometimes go with times wherein they have to make a transition. Like when the industry started, it started on Y2K. So from there it's become a service center, and today IT companies have 55% market share in IT services. So those dynamics keep on reappearing in different forms, because industries evolve, the way you transact business evolve, technologies evolve, so those are given. So I am not disturbed by those trends. But yeah, then you have to stick to companies who can tide over it. So that's what I said for Mr. Sikha. This is and for shareholder of Infosys, it's a time where they will have those things, qualities of Mr. Sikha will be tested. Under the leadership of Mr. Murthy, I have seen that he stood by it and he tied over pretty nicely and pretty gracefully. Let's see how Mr. Sikha gets it done. So I guess those are testing time for Mr. Sikha, Infosys, and many other companies who are going through this transition period. So I think some companies will tide over it. So you have to tide over, be with these companies to get into next leg of wealth creation that will happen in these IT companies.